All right, my friends, I got a lot of comments about pensions and the risk that are in a private pension. This could be even a government pension too, but mostly is a private pension that people are commenting on when I was talking about the pension, getting a pension relative to a lump sum, and then annuitizing that with a private annuity. So I did want to take some time to go over this. I think it's actually pretty important to understand the PBGC, the Pension Benefit Guarantee Corporation. Let me make sure. Okay, good. Because if you're looking at a pension, you need to know how it's insured for sure, and if it's insured, and how much of it is insured. Those three things are pretty critical. So we're going to dive into that here today. Welcome to Heritage Wealth Planning, the place you come to learn about your pension information for sure. So if a private pension or a government pension, because government pensions have a risk too. Don't get me wrong. We're not going to dive too deeply in that here today, but there's a significant risk to government pensions. But we're going to don't forget to subscribe down below, thumbs up, comments, share the video, the whole thing if you would. So the first thing we're going to do is my man Alberto sent me this link for the PBGC, and I think this is quite important to understand. The PBGC is a Pension Benefit Guarantee Corporation, a U.S. government agency, and they're the group that funds. It's like the FDIC, the financial or the Federal Deposit Insurance Corporation for banks. So banks pay a premium into the FDIC. And that's why they can put on their windows, and when you walk into a bank, it'll say member FDIC. That means they're paying a premium into FDIC to guarantee depositors X amount of dollars. When they change it from 100 to 250,000, presumably they raise the premium that these member banks had to pay. Credit unions have the same thing. NCUA, National Credit Union Administration, I'm not sure the association, I guess, same thing. They're a member of NCUA, member of FDIC. That means they pay a premium, and how that premium's determined is, my understanding, is the risk to the bank. I mean, how much risk is the FDIC taking because your bank is crappy or your bank is secure? Don't quote me on that. I don't know exactly how that works, but with any insurance, I'm sure it's the same thing. PBGC is the exact same thing. So if you want to have the government insure your pension, you be part of the PBGC and you pay a premium into the PBGC, almost like unemployment insurance. Now, unemployment insurance works that the companies pay a premium for unemployment insurance, and it's based on the risk pool of the employees. So that's why a lot of companies don't want you to, they don't want to fire you. They want you to quit. Because if you quit, and a lot of people quit, they're going to pay more premium to the unemployment insurance pool because when they fire you, they have more and more people going to draw unemployment. Because if you're fired for most reasons, you can draw unemployment. If you're fired because you're stealing or you punch the boss or something like that, that's not going to be the same. But if you're fired just because they're laying people off, you can go draw unemployment. And that pool of money that all these different entities are funneling into the insurance group, essentially, and then they're going to charge more premiums, the insurance group, to the companies that have higher layoffs. I hope that makes sense. Similar thing here, the PBGC. The more likely they're going to have to finance your pensions benefits, well, the more they're going to charge you for risk. And that only makes sense. The less likely they're going to have to finance your pension benefits, the less they're going to charge you for risk. I am not an expert on that. So if you have thoughts to add them, please put them in the show notes. I'm just telling you, I'm just going off my experience and what I know. And I am not an expert on PBGC. I know it, though, simply because I had a lot of airline pilots that got, and I don't want to say screwed, but they definitely got shafted when it came to what they thought their pension was going to be and what ended up was significant reduction in that. Now, I don't want to get to that. But I've seen it happen with my own eyes. Now, PBGC jumped in and were able to at least give them something for sure. And it's not bad for most people out there. It would not be a bad pension at all, like $3,500 a month or something like that. But when they're expecting $6,000 a month, that's a pretty significant difference. All right. So BBGC, there's a maximum monthly guaranteed tables, and this is pretty important. All right. And so you can go to pbgc.gov. It's almost like Ginnie Mae.gov. And the Ginnie Mae, again, is the government entity that backs this home right here. You all invested money in the Government National Mortgage Association, the Ginnie Mae, and they turn around and use that money to issue bonds that banks can use in which they can finance VA loans. So Veterans Administration loans are 100% backed by the Ginnie Mae. So the bank isn't on the hook. It's the Ginnie Mae that's on the hook if I become a crack dealer and I forget to pay my mortgage. The bank's got to take it over when the house is a whole lot less in value than what they loaned it to me if I'm big time upside down. So that's a Ginnie Mae. The same thing. There's an insurance fund that the government issues, and people got to pay into it. It's just the way it works. All right. This section applies only to single employer plans. All right. So single employer would be Delta Airline. What's the one we were talking about the other day? I think, my man Alberto, Boeing. I forgot. But anyway, a single employer plan. The guarantee limit for multi-employer plans is very different. A description of how multi-employer plan guarantee works is included in this link that you can click, which I won't right now. The PBGC maximum guarantee for participants in a single employer plan is determined using a formula prescribed by federal law that calls for periodic increases tied to a Social Security index. The formula provides lower amounts for younger ages, reflecting the fact that younger people receive more monthly checks over their expected lifetime. Where does that remind us of? It reminds us on Social Security claiming. If you claim at 62 versus you claim at 70, from the Social Security's position is actuarially the same. You claim at 62 at a reduced amount, you claim at 70 at a higher amount. Actuarial, the actuaries would say it's going to be the same to the Social Security risk pool because we're going to pay more to the guy who claims at 62. We're going to pay more checks, so we're going to reduce the amount of checks. We're going to reduce not the amount of checks, but the income that we pay because we're going to pay it a less amount for a longer time, if that makes sense. If a guy claims it at 70, we're going to pay a less amount of checks, but we're going to pay more. So we're going to pay more for a less amount of time. And that's the same thing here with the PBGC. The formula also calls for reducing the amount for retirees who choose a payment form that continues the benefits to a beneficiary after a retiree's death, joint and life survivor annuity. So if I get killed by the bus, my wife gets my annuity, I will receive a lesser amount while I'm alive. Inherently, that would make sense, just like an annuity, because they're going to cover two lives as opposed to one. Thus, there's more risk to the insurer, in this case, the PBGC. The maximum guarantee tables are for 2019 and earlier years provided below. Which year's maximum guarantee table applies to my plan? Each maximum guarantee table applies to a given calendar year. The table that applies to your plan depends on when your plan fails or whether your employer was in bankruptcy at the time. In general, the relevant table is the table for the year in which your plan fails, i.e. the calendar year that includes the plan's termination date. However, if your plan fails while your employer is in bankruptcy, it's the table for the year in which your employer entered bankruptcy. What age do I use to find the maximum guarantee amount that applies to my benefits? The maximum guaranteed amount is generally based on your age when you first start receiving benefits from the PBGC. However, if your plan fails while your employer is in bankruptcy, there are some special rules which apply down below. Your maximum, right here. So if you first start receiving benefits before your employer enters bankruptcy, use the age to determine your maximum pension guarantee is the date your employer entered bankruptcy, all right? So you retired, you're getting a pension, and 5 years later, your employer enters bankruptcy. Use the age on the date your employer entered bankruptcy, not when you started taking your benefit. That's a big deal, and I'll show you here in just a second. If you first start receiving benefits after your employer enters bankruptcy, but before the plan terminates, use your age on the date you started receiving benefits from the plan. All right, that's a big deal because they're saying the plan, the company went bankrupt, but the plan hasn't terminated. Basically, use the date that you used when you had your pension kicking in. After the plan terminates, this is really when the PBGC kicks in. Use the date you start receiving benefits from the PBGC. So that third one's the big deal there. That's because that's when the plan terminates and now PBGC is taking over. It's from that date forward that the PGC is going to calculate your maximum benefit. If your employer just enters bankruptcy, like what's happening with PGE, Pacific Gas and Electric in California, in of itself, that's not really going to have a huge impact yet on PBGC because theoretically, PGE is still paying the pension benefit as they were doing before. Now, if you're already on, if you're already on your pension And all of a sudden PBG claims that could change significantly your maximum benefit. And so you want to use the date in which your employer entered bankruptcy and PBGC had to kick in. All right, your maximum guaranteed amount will also reflect the age of your designated beneficiary if your benefit provides payments to a survivor. So I'm 75, my wife is 55. I mean, that's not the case, but just say that was the case. I'll get significantly less because I'm covering those two lives, one of which is significantly younger than me, which means she will live significantly longer. I'll call that. Can you use 3 significantly's in one sentence? I just did. Heritage Wealth Planning YouTube channel telling those English professors I use the same word in one sentence. Yeah. My English professor, my English teachers, and my wife even would be killing me for that. All right. If I'm 75, my wife's 75, we will get paid more than if I'm 75, my wife's 55. That's all there is to it. The reduction for the participant's age does not apply to certain disabled participants. All right. So here's the maximum PBGC monthly maximum guarantees for 2019. And we'll just say a 70-year-old guy. So I'm 70-year-old. The maximum I can get on a monthly basis monthly is $93.09. And if I have a joint in a 50% survivor annuity, so essentially what that means is my wife or my surviving spouse will get a half of my benefit over her life after I die. I will only get $83.78, and then my wife will get half of that. If it's only just me, straight life just means it's me. I will get $93.09 as my maximum benefit. I'm telling you, very few people are going to get that. If it's a 50% joint in life survivor with 50% guarantee, I will get $83.78, and then when I die, she will get half of that $83.78. If I am 70, when the PBGC kicks in. So in this case, if I'm 70 and I've already been taking my pension, all right. The most I will get if I'm 70 years old and the PBGC kicks in is $93.09, which again, for the vast majority of us, is not an issue. It's just not. Now, I heard some people say the max you can get is 10 or 15%. I don't believe that to be true. I don't see any information on that whatsoever. So if I'm getting, let's just use the USPS. It's a little bit different there because it's a government pension as opposed to private. So let's just say I retire from Boeing. I'm getting a $2,000 monthly pension. I'm still going to get $2,000 a month unless there's some contractual obligation in Boeing that I don't know how that works. But in my mind, I'm not going to worry about that too much. I'll get $2,000 a month, even if I retire at 51. The max I can get would be $2,074. So if I retire at 51 and I'm getting $2,000 a month, and then Boeing goes bankrupt and I'm 51 now, the max I'll get is $2,074, which is still above my $2,000 a month. Now, what happens if I retire at 45 at $2,000 a month, and all of a sudden Boeing goes bankrupt? Well, I am going to take a reduction. I'll get $1,400 as opposed to $2,000 a month, simply because Boeing went bankrupt, and the max PBGC is going to be on the hook for a 45-year-old guy is $1,401. Now you can go back to 2018. I'm curious. At 70, at 2019 is $9,309. At 70, 2018 is a little bit less because they're paying for longer. And we can go all the way down here. This is 2007. It's $6,847 simply because they're paying for that many more years before you die, essentially. So, I mean, pensions, PBGC, and your pension and annuity and Social Security all work to the same degree. How long are we going to be on the hook to pay this guy? And are we going to be on the hook to pay this guy and his surviving spouse? And how old is she? That's what we have to compute. And the longer we're on the hook, the less we're going to pay you up front. I mean, the less we're going to pay. It's just all there is to it. So I don't think there's much of an issue. Now, PBGC is not in a good place. I'm telling you right now, PBGC is like Medicare. These guys are hurting for sure. FDIC is in a better place, but they're not in great health either. Everyone focuses on Social Security. Social Security is actually doing quite fine relative to these other things. Medicaid, Medicare, PBGC, FDIC is probably doing pretty good. Unemployment compensation fund, the state of Florida, they got their citizens insurance fund. All these things are in a world of hurt, my friends. There's no other way around that. And I don't know when it's going to pop. I don't know what's going to, I just don't know. But you can see that what can't go on forever simply won't. So at the end of the day, is there more risk to your private pension than a private insurance company? I don't see how that could be. Because while the private insurance company issuing an annuity has a state guarantee of a certain amount, it's not much. And then the private pension is 100% backed by PBGC if, and this is where we're going to read this article from the Balance, find out if your pension benefits are guaranteed. If you have the good fortune to have a pension plan, it can provide a source of guaranteed income in retirement. The word guaranteed is used loosely, however, since plenty of cases have arisen where pension plans got into a financial mess and the companies were forced to reduce benefits being paid out to existing employees. So how do you know if your pension is guaranteed? A form of insurance from the organization called the PBGC, we just talked about it, exists to protect your pension benefits, but you need to find out if your company participates in it. If they do, at least most likely a portion, most likely all of your pension will be covered depending on how much it is. How much of your pension is safe? The amount of monthly income insured by PBGC has a cap in 2018 for a person recipient age 65 whose plan was covered by PBGC and who is taking a joint in life payout with 50% annuity. The max amount covered by the insurance was $48.78. So if we go back to 65 at 2018, we go back to 65 years old, and there you see a 50% life annuity, joint life survivor annuity is $48.78, just like our good friends at the Balance said. All right. For a single life, payouts can be more, $54.20, just because they're only covering one lives. These insured amounts apply to what's called as single employer plans. And we talked about I'm not going to get into it, multi-employer plans. If you have not yet reached 65, your full pension benefit may not be insured, even if it's less than the cap. The allowable insured amount of pension benefits are the lowest in the first years of insurance coverage, which starts at age 45. All right. So the coverage increases by a certain age factor for each year you grow older, with the maximum assured amount available by those who are those 75 or older. You can see the exact amount of monthly payment is insured based on your age by looking at what we just talked about. Not all pensions are insured. Private pensions offered by large companies typically participate in PGBC. However, pension plans offered by states and city governments do not. And that's the problem. Now, those are financed and guaranteed by the taxpayer, my friend. So Illinois, PBGC has nothing to do with it. It's actually pension benefit guarantee. So they got a typo there. But anyway, they're guaranteed by the taxpayer, which I'm telling you, Illinois is in a world of hurt. So that might be a thing you say, yeah, the taxpayers might be okay now, but at some point they're going to be on the hook and it's going to be painful. Is my plan insured single employer or is it a multi-employer? We just talked about that. Speak with your union, plan administrator, employer, or pension plan sponsor directly to see what your insurance amounts are covered and if your plan is part of the PBGC. I completely agree with that 100%. So the answer, I'm not all that worried about if you have a $2,000 pension, all right, from Boeing, and I'm just using that because Alberto was kind enough to give me all the Boeing information, which I'm going to talk about here in just a second. Hard to imagine the bulk, if not all, of your pensions not covered by PBGC. I would not sweat that. In fact, I would not sweat that to the point where I take a private annuity instead. I don't think I'd do that. Take the pension because A, the payouts can be higher, and most likely, and B, because it has the backstop called PBGC. Your private annuity only has a backstop called the State Guarantee Association, which I'm just telling you is not much. Now, the insurance company, a lot of times the insurance company is going to generate, they'll back each other up because they know if insurance is deemed to be too risky, people won't do it. And if they're not doing it, they're not paying the premiums, which is a vicious cycle. But there is no guarantee like on insurance annuities like there is on PBGC, just not for any significant amount of annuity income for sure. So I find the PBGC, while not a great stopgap, is certainly the best that we have right now. In terms of pensions versus annuities. So I would still default to taking my pension as an income stream relative to rolling it over and taking it as a lump sum for an income annuity for sure, just because like the video I did yesterday, it'll typically pay out more. But you do have some homework you need to do, my friends. You got to find out, A, is it guaranteed and how much is it? If you're getting $2,000 a month and you're 62 years old, what's your maximum guarantee? Will that be covered to you? Now, your maximum guarantee is, I'm looking at right there, you're going to be fine relative to your $2,000 a month, according to what PBGC would pay. But I don't know if you're contractually what it looks like for your own pension. You got to look into that and find out for yourself because it is a critical issue. I'll put the link here in the show notes. Alberto, thanks for posting this. This is good stuff. I tell you, folks, share the information that you have on the channel for sure because I don't have all the answers. My man Alberto doesn't have all the answers. His wife, Ann, probably does, but we don't see her commenting that much. So, but combined, we can get some good information to a lot of people out there who need it for sure. So comment, question, or comments, thumbs up, share the video, and of course, subscribe, and we'll see you next time. Thanks, guys.